As I mentioned previously, revenue, or gross receipts, is the starting place on Schedule C. From that gross revenue number, cost of goods sold is subtracted to reach gross profit. What is cost of goods sold? It is the direct costs of creating products for resale, including such costs as material, labor, and costs of shipping the materials to the business. If the business doesn't sell or manufacture inventory, such as a tax preparation or accounting service, then there will be no cost of goods sold. Cost of goods sold, or COGS, is the amount of inventory that is sold in the current period and is reported on the income statement along with revenues. Under accrual accounting rules, inventory that is not sold in the current period is posted to the inventory account until such time as the inventory is sold. It is recorded on the balance sheet, not the income statement. People can get confused with cost of goods sold. It is only used when a business produces a product or has an inventory. The accounts included in the COGS calculation will differ from one type of business to another, but the calculation is a rather basic one. Here's the formula. Start with beginning inventory, add total net inventory purchases during the year, including freight in, add labor, if any, and subtract purchases withdrawn for personal use and ending inventory. You do need to have a beginning inventory number, so ask your client to bring in his last year's return because this year's beginning inventory was last year's ending inventory on the tax return. If this taxable year is the first year that the client is in business, then beginning inventory is zero. As you may recall from Session 3, you have a choice of methods for valuing inventory at the end of the year. This is declared on the company's first tax return. While it is possible to change the valuation method, it requires special forms and conditions. These three methods are specific identification, first in, first out, usually referred to as FIFO, or last in, first out, commonly referred to as LIFO. Specific identification requires the business owner to track each individual inventory item, probably by serial number. This is particularly common in retail businesses where they sell high-cost inventory such as automobiles or boats. The FIFO and LIFO methods are what I refer to as assumptive methods. They are assuming that the inventory sold was either the oldest inventory or the most recently purchased inventory. For instance, the FIFO method assumes that the first inventory purchased was the first inventory sold. So the inventory still on hand is the most recently purchased and therefore is valued at the most recent prices. The LIFO method assumes that the most recently purchased inventory, or last in, was the most recently sold, or first out. So the inventory is valued as if it was the oldest inventory on the books. There are some terrific examples in your workbooks of how these work. When the cost of goods sold is subtracted from the gross revenue or business income, the remainder is referred to as gross profit or gross margin. Gross profit is an invaluable tool used by management. A manufacturer with higher gross margins reflects higher efficiency in turning raw materials into income. Retailers and sales personnel use gross profit to determine how much to mark up wholesale or product costs to arrive at the final price.